Gold just printed a new all-time high above the $4,600 zone, and the dollar blinked. The most important part isn't the headline or the candle. It's the shift in what the market is using as trust collateral right now, because that decides whether the next move is a controlled retest or a continuation squeeze that punishes anyone waiting for permission. Here's what we actually know from the tape. Spot gold pushed into the mid-4500s and set a record high just above $4,120 before easing a bit as some traders booked profits, while front-month US futures stayed in that same neighborhood. That's not a normal up day. That's the market re-rating the entire playing field in real time. And when gold does that, it's rarely because one headline scared someone for an afternoon. It's because some group with real size decided the old assumptions aren't stable anymore. But that's not the part that matters, because the conflict you're going to hear this week is simple and seductive. Gold is up because the world is nervous, and the dollar is down because of politics, and once things calm down, it'll all mean revert. That story feels comforting because it turns a regime shift into a mood swing, but the price action is telling you something colder. Gold is behaving like it doesn't need the dollar to collapse to win. It's acting like the dollar can still look fine on a screen while the market quietly adds a risk premium to the rules behind it. And that's where the real pressure starts. Think about what gold really is in this moment. It's not just an inflation hedge. It's not just a fear gauge. Gold is a settlement asset that doesn't require you to trust an institution's future behavior. It's the market's receipt for, I don't need your promise. So when gold breaks into fresh highs, you have to ask, who is buying that kind of insurance at this price, and what are they hedging against? Because the answer is not retail got excited. The answer is usually some combination of reserve logic, institutional risk management, and market structure forcing flows to chase. And if you understand those forces, you stop trading emotions and start reading incentives. But there's one hidden detail that reframes everything. The hidden detail is this. Currencies don't die on the day the index breaks. They die slowly in the plumbing first, through credibility, through policy predictability, through the perception that the rules can be bent to force outcomes. And gold doesn't wait for the obituary. Gold prices the doubt the moment it becomes plausible. This week's headlines are loud, sure. Geopolitics, tariff threats, institutional tensions. But the deeper story is that markets are being asked to assign probabilities to scenarios that were previously unthinkable. And when that happens, the premium for neutral collateral rises. That's why gold can surge even if the dollar hasn't crashed. Because gold is not trading a number, it's trading governance risk. Now, before anyone takes that and runs into cartoon territory, keep it grounded. Markets don't need a conspiracy to reprice. They only need incentives. If investors believe policy might be pressured, if they believe rate decisions might be pulled into political gravity, if they believe the boundary between fiscal desire and monetary constraint is getting fuzzy, they don't have to prove it in court. They just have to hedge it in the market. And gold is one of the cleanest hedges for that kind of uncertainty, because it lives outside the promise stack. But here's the twist. Once you get the first shove higher, gold becomes a market structure event too. And that's where the move turns from news into math. Let's talk about the level, because levels are where psychology turns into forced behavior. The $4,600 area is not just a big round number. It's a signal flare. It's where a lot of positioning, a lot of risk limits, and a lot of option exposure tends to cluster. When price pushes into a crowded strike zone, something changes. It stops being about who believes in gold and starts being about who is forced to manage risk. Dealers who sold calls hedge differently than traders who bought them. Funds that run volatility targets rebalance differently than people who trade on gut feel. And if you don't respect that, you'll keep asking, why is it moving? While the market is busy doing what it must. Because if this one mechanic flips, the whole setup accelerates. Here's the simple version of the options engine. When a lot of calls exist around a key strike, dealers who are short those calls can become structurally short gamma. That means, as the underlying rises, they may have to buy more underlying to stay hedged. Buying begets buying. It's reflexive. It's not a conspiracy. It's the hedging math doing what it always does. And the higher the price goes through those strikes, the more sensitive that hedging can become until the move itself becomes the catalyst. That's why breakouts above major levels can feel like the market can't stop. Not because everyone suddenly converted to the religion of gold, but because risk management became the largest buyer in the room. But that's not the part that matters. The part that matters is timing. Why now? Why this week? Because January is one of those calendar windows where positioning resets, liquidity can thin, and the market starts compressing traders into decisions as options deadlines approach. Specifically, late January brings a real forcing function in the gold options calendar for February contracts. When you get close to those last trade and settlement dates, the market gets less forgiving. People who were casually short volatility suddenly have to be precise. People who were leaning short because it S overextended, find themselves marking losses into an illiquid tape. And if that's layered on top of a macro headline cycle, you get a setup where gaps become more likely and dip buying becomes more aggressive. And that's where the real pressure starts. Now let's stack the evidence the way a skeptical investor should. One signal is never enough. Not in a market like this. You want layers, you want independent confirmations, you want things that would be hard to fake all at once. First layer, the price itself. Gold didn't just drift up, it broke into fresh highs and printed a record just above $4,120, then held near $4,590 even with profit taking. That matters because new highs change behavior. There's no bag holder supply above. There's no, I just want to get back to even selling overhead. What you have is a market discovering what the next seller even looks like. That's a different environment. It doesn't guarantee a straight line, but it changes the odds on how pullbacks behave. Second layer, the dollar index sitting near a psychologically sensitive zone. The dollar doesn't need to collapse for gold to rise, but when the dollar is hovering around the high 90s and traders are debating whether it holds or breaks key support, that's a macro amplifier. Dollar weakness can be self-reinforcing too, especially if investors begin to question the safe haven status of U.S. assets at the margin. If the dollar holds and bounces, that doesn't kill gold automatically, but it changes the speed of the move. And speed is everything in the short run. Third layer, silver joining the party and doing it violently. Silver doesn't behave like gold. It's a thinner market. It has more industrial narrative. It has more squeeze personality. So when silver is ripping to fresh records alongside gold, it's telling you something about the precious complex that isn't just cautious hedging. It suggests the bid is broad, not fragile. It suggests momentum and scarcity psychology are spilling over, and that's often when volatility becomes the weapon. Fourth layer, the calendar trigger we just talked about. Late January options. Dynamics don't guarantee a squeeze, but they raise the probability of dislocated price action. They make the market less smooth. They increase the chance that what looks like a normal pullback becomes a trap, or that what looks like a normal breakout becomes a runaway. Calendar doesn't predict direction, it predicts stress, and stress reveals who's overlevered. Fifth layer, the narrative catalyst that can't be ignored, geopolitical tension and institutional uncertainty. Markets price probability, not certainty. When headlines suggest escalating conflict risk, shifting tariff threats, and questions around policy independence, the market doesn't need to know the final outcome. It just needs to know the distribution of outcomes got fatter. Fatter tails mean higher hedging demand. Higher hedging demand means more bids under gold. That's 5 layers already, and we can add a 6th that most people never watch. The difference between a price discovery and price availability. Even when the paper price is liquid, physical constraints can show up in premiums, in delivery tightness, in the urgency of procurement. I'm not going to invent numbers here because you shouldn't trust made-up inventory figures, but the mechanism is real. Mining doesn't respond instantly. Refining and logistics have lead times. Recycling isn't a magic tap you can open overnight. So if demand surges from institutions and from people trying to de-risk their currency exposure, the market can experience a subtle availability premium. Sometimes you see it in spreads and leasing markets before the headline media even notices. But that's not the part that matters. The part that matters is what this does to price discovery next. So let's get mechanical for a moment, because mechanics is where trust is built. Gold has a normal state. It usually trades with a cost of carry. That means futures are often priced a bit above spot because money has a cost, storage has a cost, and holding a non-yielding asset has an opportunity cost. When that structure behaves normally, it tells you the market isn't screaming for immediate metal, at least not loudly enough to invert the economics. When that structure gets weird, when front-end tightness appears, when spreads behave unusually, when the market starts paying up for immediacy, that can indicate a shift from paper enthusiasm toward physical urgency. You don't need to be a professional spread trader to respect this. You just need to understand that the curve is the market's lie detector. And when a lot of people are watching only the spot chart, the curve becomes the hidden signal. Because the curve tells you whether the move is being driven by leveraged positioning that can unwind fast, or by a demand for ownership that's less sensitive to a one-day headline reversal. If the curve stays calm while spot rips, it doesn't mean the rally is fake. It means the rally is more likely being powered by financial flows and hedging. If the curve tightens, it suggests something else, urgency. And urgency is what turns volatility from entertainment into danger. Now take that and combine it with institutional flows. The biggest buyers in gold are not chasing candles because they got excited. They are buying because they manage portfolios with constraints. Central banks and reserve managers think in decades, not in tick-tock time. Large institutions think in terms of correlation regimes, tail risks, and rebalancing triggers. When the perceived stability of a policy regime shifts, they don't do a press conference, they do an allocation. Quietly at first, then less quietly. And if that flow lines up with dealer hedging and momentum funds, you don't get a gentle grind. You get a market that feels like it's being pulled uphill by a magnet. And that's where the real pressure starts. But let's respect the skeptic in you, because skepticism is what keeps you alive in markets like this. Gold at record highs is not a free lunch. It's a high volatility environment. That means even if the thesis is right, price can whip around violently. The market can punish both bulls and bears. It can do it with a brutal sequence: spike, dump, reclaim, then rip. If you're only prepared for a straight line, you'll be emotionally manipulated into the worst decisions. That's not theory. That's the design. So here's the psychology shield you need right now. Volatility doesn't just happen. It performs a function. It transfers position from impatient hands to disciplined hands. It creates proof after the fact. It makes you feel like you missed it at the top. Then it makes you feel like it's over on the first pullback. Then it rallies without you. That's how the market extracts emotional capital. The antidote is simple, and it's boring on purpose. Separate trend signals from noise. A trend signal is a level break that holds on closes, supported by follow-through and confirming behavior across related markets. Noise is the intraday violence that exists because options and leverage exist. If you can't separate those two, you'll keep trading your feelings and calling it analysis. And that's where the real pressure starts. Now let's build the near-term roadmap. Because this is what you actually came for. What matters next week and the week after. Start with the obvious. The $4,600 zone is the battlefield. Above it, the market is in price discovery. Around it, the market is deciding whether the breakout is accepted or rejected. Acceptance looks like this: pullbacks that find buyers quickly, higher lows, and closes that stay above the breakout zone more often than not. Rejection looks like this: a sharp drop back below the breakout, failure to reclaim quickly, and a series of lower highs that tells you momentum funds are unwinding. So what are the practical levels? Think in bands, not single numbers, because single numbers create false certainty. The first support band is the breakout neighborhood, roughly mid $4,500 into $4,600. If gold can't hold that area on a closing basis and start spending time below it, the next important band is the low 4,500s to high 4,400s, where you'd expect dip buying if this is a healthy retest rather than a broken move. Below that, the psychological line in the sand becomes the low 4,400s. If you lose that and can't recover, the market is telling you the move was more positioning than regime. That doesn't mean gold is dead. It means the short-term squeeze narrative loses fuel, and the market may need time to rebuild. On the dollar side, the high 90s area is the battleground. If the dollar index stabilizes and reclaims a more confident posture, think pushing back toward the 100-101 area and holding, gold can still rise, but it often rises in a choppier way. If the dollar instead loses footing and starts spending time below the 98 area, the macro tailwind for gold gets louder, not because the dollar is over, but because the market is repricing the path of real yields, risk appetite, and capital flows. And if that happens into late January option dynamics, it can get fast. But that's not the part that matters. The part that matters is the confirmation checklist you can actually follow without guessing. Confirmation number 1, does gold hold above the breakout band on daily closes? One-day spikes are entertainment. Multi-day acceptance is signal. Confirmation number 2, does silver stay strong or at least stop collapsing? Silver doesn't have to outperform every day. But if silver is making new highs and holding them while gold consolidates, that often indicates the complex is still being bid. Confirmation number 3, does the dollar bounce hard or does it bounce weak? A weak bounce is often just short covering in the dollar. A strong bounce changes the cross-asset pressure immediately. Confirmation number 4, watch the behavior around the calendar. As late January approaches, do we see volatility compress, then explode? Do we see intraday reversals that feel forced? Those are often the fingerprints of hedging flows. Confirmation number 5, watch risk assets' reaction to the same headlines. If equities wobble and gold is still firm, that tells you gold is absorbing risk premium. If equities rip and gold still holds, that tells you gold is being held for reasons beyond fear, which is even more important. Now, let's be intellectually honest and name the counterpoints, because credibility is built on what would prove you wrong. Counterpoint 1, this could be a crowded momentum trade that got ahead of itself. Profit taking at records is normal. If the market is too one-sided, it can snap back violently even in a bull regime. Counterpoint 2, policy headlines can reverse. If the narrative that drove uncertainty suddenly cools, the immediate hedging bid can fade and the market can deflate without changing the long-term case. Counterpoint 3, a sudden rise in real yields or a sharp dollar rebound can tighten financial conditions. Gold can survive that, but it may need a deeper consolidation first. So, what invalidates the near-term critical shift setup? Not a dip, not a red day. Invalidation looks like sustained failure. Repeated closes back below the breakout band, followed by lower highs that can't reclaim it while the dollar decisively regains strength. That combination would tell you the market isn't ready to price a new regime yet. It would mean the move was more about positioning and headlines than about durable flow. And that's the honest line. But even if that happens, you don't throw away the deeper question, why did gold reach a record in the first place? Because that question is about trust collateral and macro regime, not about a Tuesday candle. And that's where the real pressure starts. Now, let's put the whole thing into the clean 2 scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. Gold tags records, pulls back into the 4,500s or high 4,400s, shakes out late longs, then stabilizes and resumes grinding higher. This scenario is the one that looks boring day to day but ends up being powerful over weeks. It is also the one that tricks people emotionally because it feels like nothing is happening right before the next leg. In this scenario, the key is acceptance. Higher lows, buyers showing up on weakness, and no sustained break back into the old range. Scenario 2 is the continuation squeeze. Gold holds above the breakout band, volatility spikes into the late January window, and price runs in a way that feels almost disrespectful to pullbacks. You see sharp intraday dips that get erased quickly. You see gaps. You see the kind of movement that makes people chase at the worst time. In this scenario, the risk isn't missing the rally. The risk is getting emotionally forced into a position with the worst entry and the tightest nerves. Because squeezes don't just punish shorts, they punish undisciplined longs too. And that's where the real pressure starts. So what should a finance-minded skeptic actually do with this? Not buy because it's going up, not short because it's high. The intelligent move is to watch the structure and let the market show its hand. If you're bullish, you want confirmation that the breakout is being accepted. You want to respect that volatility can whip around even when you're right. If you're cautious, you want to see whether the market gives you a clean retest rather than a euphoric chase point. And if you're skeptical of institutions, the key is not to yell manipulation every time you see a wick. The key is to understand that market structure creates moves that look like manipulation, even when it's just hedging, liquidity, and forced behavior. That understanding is how you keep your brain from getting hijacked. And let's zoom in on that for one more beat, because it's important. The market will try to emotionally program you with 2 tricks. First trick, it will show you a vertical move and make you feel late, so you chase. Second trick, it will immediately punish the chase with a violent pullback, so you panic and sell. Then it will recover without you. That cycle is how most people get farmed. The shield is to define your levels and your conditions before you're stressed. Decide what you consider signal. Decide what you consider noise. Decide what would change your mind. If you do that, you stop being part of the liquidity the market feeds on. And that's where the real pressure starts. Now, one more underappreciated angle, global arbitrage isn't just for pros. It's a regime detector. When global uncertainty rises, capital doesn't just move into gold, it moves into what can I settle and store that doesn't depend on a single government's promise. That's why you often see simultaneous stress across multiple currencies, not just the dollar, and you see gold acting as the common denominator. When investors around the world are making the same choice for different local reasons, that creates a bid that isn't easily reversed by a single headline. It becomes structural, and structural bids don't announce themselves with fanfare. They show up as the market refusing to break down.